First thing first, let me call it out that Aadhar Housing Finance right now is not catering to the rural segment at all. What we cater to is tier 1 to tier 5. So we would, when I say tier 5, we would typically be catering to small talukas and small districts. Rural we are not catering, but yes, I agree to your point. We can see green shoots happening at the rural. So when time comes, when the right time comes, we'll try out that segment. For now,
but maybe tier 3 and beyond, that would give us a fair sense of what's happening in that part of the country, right? Or would that just...
It will give you a flavor, yes. And I tend to agree to your point. There are quite green shoots coming out of the tier 3 and beyond. And that's why, if you remember, last time I spoke about a strategy called Deeper Impact. We've got 150 branches in the Deeper Impact strategy. Now, what is Deeper Impact? Deeper Impact is something between the urban and the rural. These are small talukas, small districts. We've got 150 branches and expanding. The way we look at it as an indicator, 50 branches per year will keep adding in the tier 3, tier 4 and tier 5 kind of locations. So yes, demand is spurting. You can see a lot of consumers coming ahead and wanting to make their houses. And we've seen this demand coming, especially post-COVID. That sense of having an asset of its own. The consumers that I cater to will make a house once in a lifetime. But post-COVID, I think that sense of making one asset has kind of doubled up.
Understood. And just with regard to repayment frequency, have early repayments inched up a little bit, because that kind of somewhere indicates that there's more cash flow in the hands of tier 2 or tier 3 and beyond. Do you see some of those also happening?
Harsh, I would say that's too early because we've just started our journey towards the tier 4, tier 5. But in our kind of business, early repayment might not be the clear indicator of cash flow. It is the cash flow assessment that we do of the consumer. So has that increased? I would say yes, that has gone northwards. So when we do cash flow assessment of the consumer, the end user, we see a trend which is going northwards, which is helping us, which definitely helps us in repayments. And our more, I would say, relevant point to look at is how are the delinquency trends there, right? Yes. If there is a cash flow southwards, you would see early delinquencies. If it is northward, you would see later delinquencies or no delinquencies at all. And when I say it going northward, which means our delinquencies are well within control.
Sure. And let me also come to policy now. You've got the PMAY Yojana, and it's a slightly renewed policy now versus what we've seen over the last 10 years. So first off, just give us the viewpoint, the overview as to what's really changed in terms of policy on PMAY.
So the way we look at it, or where the housing finance industry looks at it, it is the new avatar of PMAY is much better. While on an overall basis, that 2.67 lakh subsidy has dropped to about 1.8. But I think what the government has done interestingly is this 1.8 lakh now does not go to the housing finance companies. It is supposed to be a direct credit to the consumer account. So from a housing finance company perspective, the AUM doesn't go down. That is one. The 1.8 lakh that we're talking about now is going to be spread across 5 years, which means approximately about 36,000 rupees per year. I think that's a great move by the regulator. The worry that we used to always have is that once the subsidy is credited to the consumer account, he would typically either go delinquent post that, or he would do a balance transfer of the loan. Now, if he were to take 36,000 rupees per year, at least for 5 years, he's going to be sticking across with the company that has initiated his PMAY subsidy. And he has to be a non-delinquent customer to get the next tranche of the subsidy. So it helps, I think, the overall system. The delinquencies should go down. The BT out rate should also go down.
Understood. And before I come from a company-centric standpoint, I understand that, try and come from a P&L standpoint, I understand that this is, in terms of your loan mix, this is roughly single-digit PMAY in terms of contribution to both disbursements as well as overall loan book, if I remember right, sub 5%. Do you expect that to creep up over the next maybe 2 to 3 years? Do you expect to take advantage of PMAY?
See, Harsh, ultimately the advantage goes to the end consumer. Let me explain you how this model works. So it's a refinance model. I source a customer irrespective of his PMAY subsidy or not, because the moment I source the consumer, I take it to the regulator. The regulator looks at its own eligibility criteria and either approves or disapproves. So it's a refinance model. I will not source a consumer based on the fact that he is going to get a subsidy, which means effectively means that I will not assume that he will get this income. So my FOIRs will be under control, my LTVs will be as per regulated LTVs. And if he gets well and good, his FOIR, gets released by that kind of amount. Will it have an upside on my growth? Illustratively, in the last scheme, Avatar 1, we did about 1800 crores of subsidy to about 82,000 customers. So that was huge. About 45% of my consumers got PMAY subsidy. If I go by the same data, eventually about close to about 45-50% of my consumers should get a subsidy, because we cater only to the EWS LIG segment, and that's where the subsidy is going to play a major role. Will it give an upside on my incremental sourcing mix? I would say a couple of percentages, yes, because it's still a refinance model. But the people who are on the fence, who are to decide should I take, should I not take, get pushed on the positive side of the fence, and that gives you that upside.